Great, everybody. Welcome to SumZero. Thanks for joining us. Today, we're going to be talking to Nitin Sacheti, founder of Papyrus Capital. I've known Nitin for at least 20 years now, probably longer. He's one of our earliest members on SumZero. I want to say he was probably one of the first 25 or 30 members on SumZero back when I started in 2008. He actually took a year at Harvard University where we overlapped for that 1 year as a U Chicago grad. Super smart guy, has posted a ton of amazing write-ups on SumZero. And we're going to be talking about a name today that I think is super interesting. Small cap name, kind of $2-ish billion market cap. So Nitin, I guess I'll hand it off to you. We're going to be talking about Cogent Communications. I'll let you kind of fire away. I guess maybe start with how you first came across the opportunity, and just maybe frame the discussion for us.
Yeah, and I think you're right. I think I was one of the first 50. So it's pretty incredible to see what you guys have done with the platform and how far it's come since 2008. Again, thanks for having me. So just starting with forward-looking statements, not an investment advice. Do your own homework, or invest in Papyrus and we'll do the work together. In terms of the opportunity, and to answer your question, Divya, for me, any business where there's a real sort of strategic transformation that happens is worth looking at. And I think especially when that strategic transformation is sort of being executed by a very, very smart owner manager. So Dave Schaefer, founder, CEO of Cogent, has built multiple, multi-$100 million businesses, including Cogent. He aggregated it together through sort of a number of distressed fiber purchases after the internet bubble burst. And so the opportunity here for me was really, the fact that Cogent did sort of the largest acquisition it's ever done in Sprint's fiber business. And the fact that I think these two businesses go really well together. I'll get into why that's the case, especially when it comes to monetizing the infrastructure for AI. So that was really what originally drew me to the opportunity.
Yeah, and maybe just walk us through like what their business segments are. I know there's a legacy business, and then there's this AI play. But if you can just kind of walk through the kind of the big picture structure of the business from a segment standpoint. Right?
Yeah. Just to start here, this is a good place to start on just the legacy Cogent business. So what exactly is that? It's effectively 12,000 route miles of fiber rings. And so the former CFO had told me that he thinks this is the most complete, hard to replicate ring of fiber assets in the country. And so, what is the barrier to entry here? It's really the fact that these are metro fiber rings. And so between owned fiber and very long-term leases, what Dave Schaefer's done is he's aggregated all of these rings of fibers in cities. And as we know, in terms of secret sauce, just sort of having that last mile connectivity is really what's valuable here. And so these rings basically connect office buildings and they connect data centers. And why that's interesting is because the two legacy businesses effectively utilize the rings for those two purposes. One, they had a corporate business that owns the fiber and sort of the risers that go into office buildings. Dave was very calculated about figuring out which office buildings he would go into and sort of building out the fiber, the number of customers, the price that he could get, but it's effectively very, very high-speed internet for corporate customers. And so that's a business that grows low single digits. They had a setback in COVID, obviously, with work from home, but it's back to growth. And so that's a business that grows low single digits with obviously very high incremental margins, given, the fixed nature of the infrastructure. So I would say, very good operating leverage. So, low single digit revenue growth, mid to high single digit EBITDA growth, low double digit free cash flow growth. On top of that, they have sort of the other piece of this business is using those same metro rings for net-centric customers. So what are those? That's, your Netflixes and your cable companies, just businesses that need fiber connected to to data centers. And so, again, pretty good business, not quite as good as the corporate business because you sort of own the only or one of the few connections going into that particular office building. But here there are many more connections into data centers, but still pretty good business, very good growth, right? The growth in this sort of IP transit business is effectively the growth of the public internet, right? And so streaming has really helped that. Kind of more AI use cases, on-premise has really helped that too. And so that's a business that, you're seeing some deflation on a revenue per bit basis, but you're seeing just such bandwidth growth that the revenue in that business is also sort of low to mid single digit revenue growth with similar similar operating leverage characteristics as the corporate business.
How big is the legacy business in terms of revenue?
So the legacy business in terms of revenue is something like several $100 million. 2023, 2024 pro forma for sort of the whole business was about $1 billion.
Got it. Great. Should we talk about the Sprint kind of part of this as well, or?
Yeah, so let me get into Sprint now. So why was this deal interesting? So this deal was interesting because of basically the long haul fiber that Sprint had. So this Sprint fiber was really connected mostly to towers, as you could imagine, because Sprint used it for backhaul for the wireless business. And so there were very few buyers for an asset of fiber that was connected to a bunch of cell phone towers, right? Because T-Mobile already had its own fiber network, so that's why this was duplicative in the merger. And then on top of that, obviously AT&T, Verizon have their own fiber, and so there was no real connection. I mean, going back to what I mentioned earlier about last mile connectivity here, nobody really wanted an asset that was connected to fiber asset that was connected to towers. So what's interesting here, though, is that this was, this is fiber that runs along railroad routes. It is long haul fiber. So there's something like 19,000 miles of this long haul fiber. And so why this is so interesting is because Cogent initially, and I'll get into what the Waves business is, and that's really the gem here that we're sort of betting on in this story. But so I'll get into that. But what was so interesting here is that Cogent effectively didn't have the long haul fiber it needed to run this Waves business. And Sprint didn't have the data center connectivity that it needed to do a Waves business. So they tried and they just couldn't get anywhere with it before Cogent acquired. So these two businesses coming together was effectively, fitting like a well-fitted glove. So in the sense that you had this asset that Cogent paid very little for because very few other buyers wanted it. It was burning a lot of cash. Dave looked at that sort of the burn and thought that he could take a lot of cost out of this business. Other people were really looking at it, kind of didn't need the Zayo, Lumen, the competitors, and sort of the Waves and the long haul fiber market didn't really need more duplicative assets. So there were no real buyers for it. And then T-Mobile was also in sort of their agreements, regulatory agreements, they were not allowed to fire, employees. And so, and again, this was a duplicative asset for them. So there was very few buyers for the asset, and it fits really well with what Cogent's doing, which is what
I want to make sure I'm reading the slide correctly. This is $20 billion of invested capital in long haul fiber that they bought for $1. Am I reading that right?
Yep. Yeah. So that's what's so fascinating here. And that's the key, is that they paid almost nothing for this asset because it was burning so much. Right. It was burning $365 million. $1 million a day was the burn. And so nobody really wanted that. Again, T-Mobile couldn't do anything with it because they couldn't fire any of the employees associated with this. And it was such a duplicative asset that they couldn't even monetize in any way. So for them, they got it off their balance sheet for their income statement. For Dave, it was a home run to, yes, he inherited, a business that was generating a lot in losses. And that's a lot of the reason why the stock is down and why it's here. But his ability to kind of cost cut here and his ability to combine it with last mile connectivity with his core business is really what creates the opportunity.
Super interesting. How is that? Well, let's talk about waves specifically. First of all, what is it? And then we can get into sort of the. I'm really curious to hear how they are doing in terms of turning that loss around and actually making money off all this infrastructure.
Yeah, so they targeted something like 220 to 250 million in. So let me step back. 365 million was the burn when the deal was announced. When the deal closed between Sprint and Cogent, which was May of 2023, that burn was down to 250, 260 million because Cogent was kind of getting in there and sort of reducing some of that burn. They've basically eliminated. So he had about a 220 to 230 million dollar cost related cost cutting plan that he had, and he's fully executed on that as of Q4 of 2024. And so they have basically so what's happened with that, and I'll get into waves in a second, but I'm just answering your question here in terms of sort of integrating these two businesses in the burn, and this kind of speaks to the execution of Cogent management too. And so they've been able to cut a lot of that burn out, but a large part of cutting that burn out was eliminating some sort of negative margin and zero margin revenue, and what they're calling their pruning effort. And so that pruning effort has basically resulted in top line revenue declines, even though it's caused margin expansion. And the key to that and why that's interesting is because Cogent right now, in terms of, I'll get into why the stock's misvalued, but it doesn't screen well, partially because you're showing top line revenue declines, and that's really because of pruning that uneconomic Sprint revenue, to your point, that's caused that cash burn to go down to zero. So a lot of things are still on the come here in terms of this Cogent Sprint story. But one thing to tell you based on your question, Divya, is that that first box has been checked, right? They've cut those costs faster than they expected they would, and they're now free cash flow neutral for that legacy Sprint business. So now the wood to chop is really on the Waves side. So what is Waves, to answer your next question? So that's effectively point-to-point optical connectivity between data centers. And so what I would tell you is this is really, in my opinion, this is really the only thing that's growing in telecom right now. We all know wireless is going through massive price wars. Cable is obviously getting its lunch eaten by fixed wireless. There is very little growth out there in US telecom in anything except Waves. And there are very few companies out there doing this. So question then, why is Waves growing? And so, we all know the data center, the AI story, the ChatGPT and LLM story, right? So there's so many more data centers being built. I think Torsten from Apollo had some stat last week about how 1 percentage point of GDP growth is just coming from data center builds. So the data center builds are massive. When Cogent originally did this deal and started talking about the Waves opportunity, they were talking about 250 million to 500 million dollar, 250 million, 500 million dollar opportunity for them, and they thought they were going to take 25% of the market at that number. I think the market is significantly larger than it originally was when they came up with those numbers, for what that's worth. But so again, what is Waves? It's this point-to-point optical connectivity between data centers. So if you're a hyperscaler, you're Amazon, you have two data centers, you need the fastest, the lowest latency connection, the highest bandwidth connection between two data centers. And that is Waves because it's effectively a private connection, right? On one end of the spectrum, you have the public internet, right? The public internet is everybody using the same pipes to transmit data. And that's effectively what Cogent's net-centric business is. Here, you're effectively taking, fiber, and you are offering, a private point-to-point optical connection between two data centers. And so, again, why is that valuable in an AI world? It's valuable in an AI world because because you effectively need, if you have a data center with your GPUs in it, and that data center has, the right power levels and the right cooling levels, which is perfect for sort of LLMs, right? But then if you have data that's the training and the inference data for those GPUs in a totally different data center, you're going to, as we all know from when we do, queries on ChatGPT, right? You're going to want that training and that inference to be done as fast as possible. And so that really comes from connecting connecting all of these different data centers where the data's in one place and the compute might be done in another. And so I think that's really why Waves is growing. And then the other piece to mention here is really the redundancy. And so right now, if you're Amazon and you are working with Zayo and Lumen, right, who are the two big wave providers in the country, these guys there's two reasons why Cogent's product and architecture and setup is so interesting. And that's because Zayo and Lumen effectively cobbled a lot of their fiber together through a ton of different acquisitions. And a lot of that fiber sits in the same conduits, right? That was built together in sort of the internet bubble. And so if any of that fiber gets cut, and you're an AWS, and that fiber gets cut, that's a connection to your data center, right? And we see the headlines when data centers go down. And so the thing with Cogent and with the Sprint fiber that's so interesting is that these are 90% unique routes. And so that 90% unique route allows somebody like an Amazon to use Cogent for redundancy. And when you're talking about a $2,000 monthly ARPU, so call that 25 grand a year, you can bet that they'll pay that as a small kind of insurance policy on making sure that they have a redundant connection to a data center. So that's hugely valuable, I think, for Cogent sort of actually expanding the size of the market rather than taking share from Zayo and Lumen. Customer checks of mine have already shown that Cogent is starting to take share. Really, they only turned on this business in Q1 2025, but they're starting to take share. They're pricing 20 to 30% discounts to competitors. And so I think all of that speaks to growing and building this business.
Is the moat around what these guys do, like this, the fact that they have unique routes, or like what would you say is?
So I think like anything else, right? The moat is multiple things all layered together to create the real moat, right? And so I think that's, again, last mile connectivity. There aren't too many people connected to these data centers with the long haul fiber and sort of this entire network, right? To be able to do this at scale nationwide. That's the first thing, right? It's really there's just them, Zayo and them now, and Zayo and Lumen. So that's the first piece. The set, from what I understand, they got a large customer from Chicago to Seattle, and you need scale to do that route, right? When you're going cross country with these routes, you need scale. So that's the first thing. I would say the second thing is that we've heard that Cogent has a really high quality CRM system that their salespeople use, and that CRM system is kind of mapped together where all of the connections are in these data centers, where Cogent's rings are, and that provides really easy access to, in terms of like customer intelligence. So I think that's something they've used in the NetCentric business. I think that's a barrier to entry. I think the third barrier to entry is really the fact that they have these rings, right? So what they've done, and I'll get into the delays in this Waves business and why kind of the opportunity of the stock exists, because they've delayed kind of building out the original targets around revenue guidance on Waves. And so some of that is because they have these rings that I was talking about. And so these rings in metro areas, originally Cogent's rings for the most part had connected a lot of their data centers in the same rings as the corporate buildings. And that was fine for them when they were doing NetCentric and doing corporate. Now what happened was they had to go into those rings and effectively separate them out, so that you had one ring for NetCentric/Waves and then rings for corporate customers. And so by going in there and separating them out, you're able to go and offer a connection from, call it Boston to Seattle, for a customer that might run through a ring in Chicago, right? Because that's the way kind of these connects work, right? They're connected from one city to another. And by separating that out, you're able to offer one. They did those separations ahead of time. And so when they did those separations ahead of time, it allows them to send a truck roll in at one end and then the other end, so call it Boston and Seattle in this case, and no truck roll in between. And so what that does is it helps reduce the provisioning times. And so again, another customer I was talking to was telling me that These guys are doing 30 days or less in terms of provisioning a wave, whereas Zayo and Lumen, they might have to go in and be like, well, we don't have a direct connect between Boston and Seattle, so we need to send truck rolls in between and make the connections so that we can get that one wave running cross country. And so I think that the point from that is that the provisioning times are faster, and customers look at that and say, I don't want to wait 3 to 6 months to get a wave provisioned. I need it now. I need 30 days. And I think that's part of the secret sauce too, that sort of it is going to help with growing the business fast and is a major advantage for them. So it's sort of all of the above in a growing market.
So speaking of growing things fast, what is the total market opportunity for waves? I mean, where do you see this? What is the TAM for this part of their business?
So I think so they've connected to 850 data centers, or it's even higher now. It's closer to 900. But and so in theory, if you think of if you were to connect all these data centers, in theory, you could have 360,000 connections. Obviously, that's not, you don't have people that need to connect to every single data center and every potential combination. So but you only need 20,000 to get to their 500 million in revenue number at a $2,000 monthly ARPU. And I think that's pretty easy to hit. One of the things you saw this past quarter was that they already got the backlog. Literally, they turned on the business for a couple months in Q1, and they already got 2,500 kind of incremental net adds into backlog. And so the importance of that is to show you that they're already over 10% of the way to the number of connections they need to hit their 20,000. Obviously, that's backlog. It's not actual conversion. So, some will fall out. But the point being, it just shows you how much of a need there is for this business, that it's growing, that people want their service. The other thing to say is that this past quarter, of the connections that they had, they said about 10% was share wins from Zayo and Lumen. The other 90% was new stuff. So that's either, redundancy or it's new data centers. And so that's kind of huge, in my opinion, that it's not like you have to price compete to steal share. This is a market that's really growing. If the guy that just comes into the space, 90% of their customers are new.
At what point did you start looking, I mean, the stock's fallen a lot in the last year. So when did you first start looking at it versus where it is now? I mean, the stock hasn't really moved. I'm looking at the 5-year chart, it's down 37%, but in the last, 6 months, it's down, a lot more than that. And I'm just curious, when did it first hit what price did it first hit your radar? And when were you kind of like, okay, this is now really actionable?
So I had followed Cogent, owned it in 2011, 2012, and then it kind of got to fair value, in my opinion. So I just hadn't looked at the company for 10 or 12 years. And then last year I dusted it off again on this deal. And I'd been following it since kind of late 23 when the deal was done. I was like, oh, it sounds interesting. Stock got into the 50s last summer, and then I started looking at it for real, and then very seriously. And then I went to DC and I sat down with Dave, and he was nice enough to give me an hour and a half, 2 hours of his time, which I really appreciated. And really kind of got after I spent sort of a lot of time ahead of time, obviously prepping, got a really good sense from him as to what exactly he was doing with this business. And then kind of lightning struck for me. And between doing the work and then going to see him, I think after I walked out of his office, I put in sort of my first buy orders. And so I originally got in sort of in the 50s. Then I think people got really excited about waves coming in Q1, and so the stock rallied into the 80s. I think the high was the 80s. I lightened most of my position between then and early this year, and then stock came back into the 50s and the 40s, and then I've gotten very aggressive with it again because I feel like the drop was some volatility, market related, some people just scared that waves isn't coming. Again, my customer checks have told me otherwise. And so I think the opportunity is here, and I think it's real. And I'm underwriting the same numbers that I did mid last summer. I just think we're a lot closer now than we were then. So I thought it was a 3x from the 50s when I bought it originally. I still think that's the case.
Is the name fairly sheltered from the tariff situation going on? Just talk about
Yeah,
macro a
good
little bit.
question.
I know it's on a lot of people.
So yeah, so what I would say is for the most part, they did all of the work they needed to do in terms of the optical equipment that they had to buy for the data centers. And then I haven't gotten into the hidden assets yet. I'll get into that too. But because there's some equipment that they had to buy for those, but all the equipment that they really needed for the data centers to kind of get wave service going has really been purchased. There is apparently, so there's 10 gig, 100 gig, up to 400 gig waves. And so the apparently some of the 10 gig equipment is on back order because of tariffs. And so, but there's ample 100 gig equipment. And so what Cogent is actually doing right now is when a customer wants 10 gigs, they're giving them 100 right now, because they have the equipment for 100 and they're charging them for the price of the 10. So I think that's a short-term temporary, discount to ARPU, which we're going to probably see. But what they're doing, I mean, that's how they're sort of getting around some of the short-term issues around, probably like some sort of issues with equipment ahead of time. But this isn't really a business where you have a high sort of cost of goods sold and large equipment purchases ahead of service. So, you're not, at the end of the day, it's kind of a services business on your infrastructure. So I don't think you're going to see big tariff impact from it.
And then you mentioned hidden assets. Maybe walk us through those.
Yeah. So I can get into sort of where the stock is misvalued to and go back to that slide. But to answer your question, I think this is sort of the best way to look at hidden assets. So in part of that Sprint deal, Cogent got 1,300 telecom switching facilities. And so what that was, old facilities that were full of racks of telecom equipment. I think the example I mention is like you think about like the 1950s switchboard, right, where you had operators sitting there and like routing calls, right? That was the original version, and then there was sort of automated switches, and that's what these were. These were sort of automated switching facilities, and so they acquired 1,300 of these, obviously for nothing in the deal. And they basically, what Dave looked at is he realized that these switching facilities all have power, and they have contracted power with the local utilities. And of those 1,300, he effectively, whittled them down to 24 that he thought were big enough in the right areas to turn into data centers because they already had contracted power. And we all sort of know the data center story right now with power and the fact that if you have contracted power into a facility that can be used for a data center, it's gold. And so this is one of the kind of the hidden assets here. And so that is these 24 facilities. You go on LoopNet, you can see that the facilities are on the market. So what they did was they took the telecom switching equipment out, and then they replaced it with servers and racks of servers. And they are in the process of selling these data centers with contracted power. Now, these aren't perfectly architected for AI workloads because again, these are old switching facilities with sort of small rooms, different hallways, not quite data center setup, but they sort of work as edge data centers. And, as management has publicly stated, they have something like 4 offers right now for either the entire suite of 24 data centers or some of the individual data centers. And they originally put out an ask of $10 million per megawatt. And so they have about 100 megawatts. So that's, $1 billion in value. They have not hit that number in terms of price of received, but they are not wedded to that. That was in their mind, sort of as Dave has put it, that's the balloon that we put in the air to see if there was interest, and we got a lot of interest. So my sense is that they will sell these data centers for, $6-7 million a megawatt, and over the next couple of years. And so I think that's something after tax, something like $500 million in proceeds that they'll receive from the sale of these data centers. The other interesting business that they have here are IPv4 addresses. And so what that essentially is every internet connected device, even, your toaster that's connected to the internet has an IP address, right? And so that's the way that every device talks to the internet. So in sort of the advent of IoT, you have more internet connected devices, and you don't have more IP addresses being made. And so these IP addresses generate, are growing in value. Cogent recently had them, they have 38 million of them. So they had 28 million of their own. They got about 10 million in the Sprint deal. So they have 38 million now. They are leasing a lot of these IP addresses for something like 50 cents a month. And, these IP addresses, are very high margin, obviously revenue stream. They've appraised them at something like $2 billion, and that value is growing. So again, this company, like Divya mentioned before, a couple $1 billion market cap, $1.5 billion in debt. And so $1.7 billion in debt. And so basically they have $2 billion in value in just the IP addresses, plus another, several hundred million in the data center. So what are they doing to monetize the IP addresses? What they're doing right now is Dave thinks that the value will keep on growing over time. And so he's effectively securitizing them. And so he's raising, call it a couple $100 million on a clip, at 6 1/3 or so interest rate. Raising that money up front through a securitization on a 5-year term. Using that cash for, essentially previously to kind of grow the business, pay the dividend, invest in CapEx while we're waiting for the Waves business to grow. So, should they have the need, they can sell those IP addresses, I think, easily at $2 billion today, but he doesn't want to because he sees value increasing for
That's
him.
an interesting hidden asset there for sure. Nitin, you mentioned some primary checks earlier. Have you used AlphaSense at all for the purpose of that
So using
business?
AlphaSense,
How you
recently acquired by AlphaSense.
that?
Yeah, they've been valuable in terms of getting the right people to meet to do those checks. And I think in a story like this, to your point, I think that the sell side, and this kind of opens up a broader question, right? The sell side is they haven't really incorporated Waves into too many of the models. You can go through and look at those. They haven't incorporated the value of the hidden assets here. They're looking at, they're looking at delays in Wave guidance. They're looking at the capital structure, right? You can see on the left in this chart that revenue went up. This is sort of 2022 versus 2024. And so what this is showing us, and what I'm trying to show here, is that, revenue obviously went up a lot when they acquired the Sprint business, but network costs went up significantly. OpEx was up significantly. EBITDA was down a lot because of all of that inherited cost structure, bloated cost structure I mentioned earlier. And so, CapEx, obviously that CapEx number is up substantially, and that's on its way down. All of that is to show you that they're barely covering the dividend right now. And, the sell side's really scared about that. And they look at any stock where the dividend isn't covered, that's levered, that has top line revenue declines, and, they run in the opposite direction. So all of that's a very long-winded way of saying why I think the stock is misvalued here and why people are misestimating the Waves opportunity, why I think the sell side, when Waves really starts, they'll step in, right? And so what is our job? It's to be ahead of all that, right? And I think something like the AlphaSense expert, expert calls that I've done have been helpful in kind of getting me, again, comfortable that this business is real, that Dave is doing it differently than everybody else. And, you're really going to start in the next couple quarters to see it come to fruition.
Super interesting. I guess when you add it all up, the hidden assets, the Waves opportunity, the legacy business, kind of the full picture. I mean, how do you think about valuation here, and what's sort of the, curious to hear kind of your base case and blue sky scenario, as well as like any kind of downside risks you see to your thesis.
Yeah, I mean, I think, like I mentioned earlier on the legacy business, those are the numbers we're using for forecasting. Yeah, management's basically talked about how by Q3 they'll be done with some of the pruning of the Sprint business, and so in terms of the revenue, and so I think by Q3 we'll start to see that revenue decline go away, and I think people will get a lot more comfortable just from sort of a just the cleanliness of the story once that pruning stops and they print a positive revenue growth number, because that'll be sort of the legacy Cogent business kind of shining through. I think Waves is really going to start the next couple quarters. I'm looking at sort of 20,000 customers by 2026, like I mentioned before, with continued, very strong growth, 50% contribution margins, which I think are conservative because I know they're paying their sales force really well right now to grow that business. I think you have some delevering from the data center sales. They just did a sort of a secured debt raise yesterday at 6.25, 6.5%, and that's being used to refinance the 2026 maturities they have. So those get pushed back to 2032, and then they have 27 maturities that I think they're going to pay down, either all of it or half of it, with proceeds from continued IP address securitization and data center sales. And so that takes out some sort of higher cost debt, which will obviously help with interest expense and free cash flow. And I think maintenance CapEx comes down pretty substantially. So I think, what you end up seeing is you basically end up seeing revenue growing pretty steadily, mainly from Waves. You have a very good contribution margin. And again, there's not much incremental OpEx, not much incremental cost of sales from Waves because, again, this is all shared infrastructure. We know CapEx is coming down because a lot of that CapEx spend was sort of separating the rings, connecting the data centers, and then getting those Sprint switching facilities, turning them into data centers to sell. And so I'm pretty sure CapEx comes down. And so when you kind of layer all of that together, I get to $10 in free cash flow per share by 2028. And, some of that is a couple dollars of that is, interest expense and CapEx. A couple dollars, $3 or so of that is growth in the core business at really high incremental margins. And then another few dollars of that is Waves. And so it's sort of this layering of all these opportunities, from the delevering, from the lower CapEx, from the growth in Waves, and from the growth in the core business.
And so, what multiple do you put on that free cash flow? Just remind me your target on the name?
Yeah, I mean, I put a 15 times on it. I think this is a business that, again, is very hard to replicate. It has many billions and billions of dollars of invested capital in both assets. So I put a 15 times multiple on that because I think it's stable, it's subscription based, it's growing, and it's got high operating leverage. And I think your leverage on the balance sheet declines with the hidden asset sales.
And how do you get around all the insider selling? We actually already got a question about Dave selling 65,000 shares in June. Just kind of talk about that.
Yeah, so what I would say is that this is some of the hair on the name and why I think there's so much upside here. So I think the point is that Dave has, like I said earlier, he's built multiple billion-dollar businesses, or several $100 million businesses, I should say. One of those businesses that he built was a personal real estate portfolio. So he's probably one of the best sort of distressed buyers of assets I've ever seen. Like I said, he bought the he bought basically what turned into the Cogent business by buying distressed fiber assets after the internet bubble burst. After sort of the recession in 2008, 2009, he was buying commercial real estate in DC and made a ton of money on that. Before all of this, Dave actually was a PhD student, and he left his PhD program to basically run his dad's taxi company in DC because it was in financial distress. And Dave turned it into basically the most successful taxi company in DC with his brothers. And so this is a manager who has a history of real value creation. Where did he get himself into a little bit of trouble more recently? He levered up his real estate portfolio. And so his real estate portfolio, and again, I have asked him if he doesn't mind my sharing this personal information. He said he's totally an open book about it. And so, Dave had basically about $1.1 billion portfolio of personal real estate in a few years ago. And you had kind of COVID, you had work from home, DC didn't really come back. Then you've had some of the Doge cuts, you've had higher interest rates, you had regional banks getting hit by what happened with SVP and First Republic. So you kind of have had this perfect storm of negative events for him in his real estate portfolio, all while he bought a little bit more after he kind of got some distress, after he got some deals on more office buildings, post COVID. And so he had about $1.1 billion at the peak in terms of value. That's down to about 600 million today. And I'm sure if you did appraisals of the buildings, it would probably be lower than that. He had 500 million in debt on these buildings. And now he has paid off a lot of that, right? So his LTV didn't look bad when he had a $1.1 billion real estate portfolio. But with now that value down to 600 million and with 500 million in debt on the balance sheet, he's been able to cut that down. So he's been selling stock, he's been selling other personal assets to get his leverage down to just over 400 million now. As he sells and he pledged some Cogent shares for taxes that he had to pay, because he's been taking the dividends out of Cogent, as a return of cash. And so his basis is pretty low in his Cogent stock. So when he sells Cogent stock, he now has to pay taxes on it. So, this is sort of a perfect storm of personal issues that he has had, that has caused him to have to lighten his Cogent position. And again, all the buildings are on CoStar. All the buildings are in his proxy under the LLCs that they're, underneath. And so you can vet all of this and understand that it's all real and true. So it's not like this is some house of cards and this is a CEO bailing for, a reason that's related to a risk of Cogent. This is, something he's doing for his own personal balance sheet.
It sounds like he's a forced seller, and maybe his personal debt issues have stabilized a little bit.
I think they will in the next 12 months, is at least what he's mentioned.
That's also partly why the stock's cheap. I mean,
exactly.
Yeah.
And I think that's what it comes down to, right? Is that you're getting part of this opportunity because optically, like the reason I'm going into so much detail about his personal balance sheet is because I think people need to know that that's the reason why this is happening, right? But optically, it looks really, really bad. But if you can understand that, come to terms with it, and get through it, that's again part of the opportunity here.
Is most of his net worth, when you look at his actual net worth, net equity, is it mostly in Cogent at this point? It sounds like the real estate.
He has a little bit of real estate. He has a little bit of personal real estate, right? An apartment in New York, a house, a summer house, and a house in DC. So not very much personal real estate, but then it's pretty much all Cogent stock, and it was his real estate portfolio. But obviously, the equity value in that's dried up a bit. But again, this is a person that works 15 hours a day, from what I understand, and this is his life. He's going to keep on running this business, even if he owns 6% of the company rather than 10%, right?
Yeah. So I mean, if you take your multiple assumption of 15 times, you're kind of near the share price for 2020, based on the 2026 numbers. Would you apply that to the 2027 number, or what? How do you think about today's stock price versus your target? Just curious.
Yeah, I mean, I think for a business like this that's growing as much as this is going to grow, and it's not, short-term growth, you get to this 2028 number and then growth goes down to 3%, right? I think that there's significant growth in waves after that. So I'm happy putting a 15 times on my 2028 number because I think, it's even though it's a couple years out, it's facilities based and there's real growth.
Yeah, super interesting, Nitin. This was great. I think we covered the questions that folks kind of put into the chat. So, I think unless there's anything else you feel like you missed or want to expound on, we can certainly call it here. And I'll certainly be following the name. I always love seeing, companies that make real things, like talked about, because there's so much of what people or there's a lot of economic energy and market cap on completely digital things that can be very trendy. But maybe last question from Jordan Fox here. Biggest risk beyond kind of the CEO's problems and all of that to your thesis. I mean, what would you say is, like, where do you see kind of your thesis cracking? Is it the debt situation? Is it the demand on the data center side, or where do you think there's potential risk here?
Yeah, I mean, I think it's delay on waves, right? What if ARPUs come in lower than expected earlier on the next couple quarters, and then after that, it's just so the three, I guess apparently the three ways that customers decide on waves are price, latency, and resilience. And so price is obviously you get that up front. That's not anything that's debatable. Latency can be tested with a ping, just like we do like our phones with like an Ookla speed test. And then resiliency is really the other piece. And so customers need to see that the network is resilient and there aren't outages. And if there is an outage, then a truck roll gets out there really quickly and it's back up and running, right? So that's really the biggest risk in my opinion, is really a delay in wave sales because customers are watching and waiting for, to see if the network works. Everything I've seen shows it does. But yeah, that would be it for me. And then, with that and with, the data center sales are later than expected, how do you handle the maturities? You effectively refi everything rather than, pay down the 27s.
Great, Nitin. I think we can close with that. Thanks for giving us all the detail on a pretty interesting situation. Hopefully, you're right and you double your money from current levels. and thanks to Alpha Sense for sponsoring this. So we'll end with that. Thanks so much, guys.